All right, perfect. So let's move forward with this session. Again, if you have any questions, please feel free to keep writing in the chat. So, what is technical analysis? So, basically, we need to see what are the type of analysis that people do before taking an investment or a trading decision. So, let's first go ahead and see what technical analysis is. Basically, technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends. In short, let me put this in much more easier words. When they say statistical trends, they're talking about tools that they use to see the previous price action that has happened on a particular commodity or on a particular stock or even on currencies. So technical analysis, basically the foundation of it can be used on any asset class. It does not necessarily have to do with only certain products. You can use the same technical analysis on pretty much anything that has price action. Now, for example, the other types of analysis that people do is fundamental analysis. They also do quantitative analysis, but the most foundational ones are fundamental analysis and technical analysis. Now, just to give you a small difference between what a fundamental analysis and technical analysis is, let's say for fundamental analysis, you're looking at Apple share or yesterday was Tesla's earnings. So let's take Tesla as an example. So now, when you do a fundamental analysis, you try to understand about the company, what they do, their products, what kind of innovation do they have in their products, and what is the future prospect. Are there products that are being innovated much better than others in the market? Are they the ones that are pioneer in the market and the only ones who will dominate the market share? So these all come under fundamental analysis, and of course, you study the financials of the company to see where they stand financially, and you look at their quarter-on-quarter earnings, year-on-year earnings, and then take a decision whether if the company is worth being invested in. Now, that is fundamental analysis. And what does fundamental analysis actually help us with? It mostly helps us with a long term investment decision making. Now, you would want to understand fundamentally what is happening in the company on an everyday basis, but you will not necessarily use those fundamentals to take a daily trade, but you would always look at fundamentals so that you know in the next 2 to 3 years or 5 years, if you're having a long-term investment plan, you would want to understand what the company is doing and how they're doing and will it sustain for the next 5 years to be profitable for you. And that is where most fundamental analysis will be used and very minimal of technical analysis. Now, again, coming to what technical analysis is, like I mentioned to you earlier, it is price action. In simple words, let's say we take a stock, for example. The stock is trading between 100. The stock started trading at $100, and then probably a couple months later, it went to 120. And then a few days later, you see it come back to 110, and then a couple of weeks later you see it go back to 120 again, then another few weeks later you see it come back to 110, and then again maybe a couple of weeks or months later you see it go back to 120. Now, you notice the pattern over here in the example that I gave you, right? You understand that every time the stock comes to 110, it tends to jump back up. Now, why does it jump back up? Behind that, what is the psychology? Why a price action pretty much happens around the same area? We will get into it. I will show you a couple of examples on that. But in this example, it is very clear case where every time it comes to 110, you buy. Every time it goes to 120, you sell. Now these are short-term analysis. Now you can do the same thing on a long-term basis. Let's say you're looking at a stock for last 5 years, and you notice every time the stock makes a new high. Let's say the stock went for the very first time, it had made a new high, and from there it starts dropping, and maybe 1 quarter or a year later it drops by 35%, and it starts picking up again after that 35% drop, and the second year it again goes up, then it makes a new high, and then from there again, probably during the third year, it starts dropping, and you see it drop again by 35% before it again starts climbing back up. Now, in this case, the price action that you have noticed, the statistical trends that you've seen in this particular example is every time the stock is at a discount of 35%, people are jumping in to buy it because they're getting the same stock at a 35% discounted price. Similarly, how we do shopping, we wait for a discount in the price when we want to buy something for ourselves, irrespective of what the asset class is. Probably it might be a phone, a laptop, clothing. You always wait for a discount so that you get a much better deal. So similarly, technical analysis is used in the same way. Everyone looks to buy at a lower price, and then when it goes back up, they want to take advantage of the upside moment and take profits on those. Now, usually technical analysis are used with the example that I gave you on a smaller time frame. People use technical analysis when they're trying to take a trade on a 15-minute chart. Now, on a 15-minute chart, Apple, fundamentally being a very strong company, will actually not help me a lot because I know that Apple is a fundamentally strong company. But on a 15-minute time frame, Apple can still move both direction up and down because I'm just looking at the current momentum in the trade. And now these up and down movement that happens on 15 minutes or 30 minutes chart does not always necessarily have to depend on the Apple as a company or Apple fundamentals of the company. It depends on the buying and selling of the volume done in that region because every day there are people buying and there are people selling it off. Now, when you're looking at a 15-minute chart, this is where technical analysis would be more important. And there is also always a saying when you're doing technical analysis, fundamentals are pretty much discounted. Now, please bear in mind if you're doing technical analysis for on a monthly chart or a weekly chart, you're basically trying to gauge in terms of when to buy, and your minimum holding expectation would be anywhere between 2 to 5 years. So when you're doing anything for a long duration, you can still use technical analysis, but that is for long duration. Fundamentals is more key, and of course, technical analysis still helps you identify a good price to enter, but fundamentals is still key. For example, let's say if Apple drops 30% from its all-time high, it is a good 30% discount for us to buy Apple. But in the next 5 to 10 years, if I see Apple is not a very good fundamentally strong company, me buying it at 30% discount is pretty much dangerous because maybe if, I mean, of course, Apple is a good strong company, but if it wasn't, then I'm in danger of Apple actually dropping down to 50, 60, or 80%, and one day even file bankruptcy. And at that point of time, my analysis on technicals did give me a good entry point, but my fundamentals never supported for the next 3 to 5 years. So this is basically the key difference between fundamental and technical analysis. Now let's. I hope you'll have understood the importance of technical analysis and how people use it with the definition. We'll get into more detail in terms of how to analyze using technical analysis. If you all have any questions, please feel free to keep writing to me. All right, so now let's just go over the charting. I'm sure most of you all have been trading. If you haven't been, if this is the very first time you're looking at trading or investing, do not worry. There are different types of charting. I'm sure all of us have seen charting or done courses or in our school seen different type of charting. One is the line chart. Basically, line chart just represents the price movement based on using just a line. It's self-explanatory. And there is candlestick chart. Now, candlestick patterns are basically it forms a candle for every duration. Now, for example, if I'm looking at a daily chart, a candle represents a day's move. Now, each candle has four characteristics to it, or four important criterias in a candle which defines the candle. Now, one is the body. I mean, you see the body, and then you have the wick, as seen in this particular example. Now, if you're looking at the wick, it says high here, and the lower wick it says low. and if you see, it says open and close. Now what does this actually mean? What it means is the price opened at this price, it went as low as these levels, it came back to its open price. So, and then it moved above and it made a high, but it closed a little lower than the high price. So your open and close always forms the body of the candle. Your high and low just tells you how many dollars it had actually gone up during the day, but the most significant thing is where it actually closed during the day. So open and close is very key in looking at especially when you're doing technical analysis. Open prices and close prices will give you a lot of in-depth analysis when you're doing a chart analysis, or if you're looking at candlesticks patterns. But at the same time, it does not mean the high and the low is insignificant. They are also equivalently significant. But in the candle formation, all of this play an important role. The most important thing we need to understand is whenever you see a green candle, that means it is understood that the price opened lower and it closed higher, and hence it becomes a green candle. And vice versa, if the price had to open on the higher end and then had to close on the lower end, then you will see the candle being in red. High and low remains the same. Now let's go into support and resistance. Now I think most of you will understand support and resistance. Support and resistance, again, with the example that I gave you of a stock which was trading at 100, it went up till 120, and then ever since it's been trading between 110, 120, 110 and 120. So now you understand that 110 is your support, because every time it comes as low as 110, it is taking support and it is bouncing back up. So that is why it is known as a support. And on the other hand, every time it goes to 120, it takes resistance. It's not able to break above 120, and hence it is known as resistance. Now, how do people use support and resistance? Very simple. Every time they see it at support, they look to buy. Every time they see it at resistance, they look to sell. Now, in this case, you see there is a trending market. Now, in a trending market, price action does not go like the one example that I gave you. I said 100 to 120, back to 110, 120, 110. Now, in a trending market, how a price action would work is every time the market goes up, it comes lower, but after that, it makes a new high, and then again it drops a little lower, and then it makes a new high. Now this is the second example that I've given you. We see market going up and then giving a drop of 35%, and every time it drops by 35%, you see the market again recovering from there, and then probably make a new high before it drops again 35% of the new high. Excuse me. So that is a trending market. I will show you more examples of a trending market while as we do the practical demonstration of the support and resistance. Now, in terms of the way people look at it is trade the bounce. So buy when the price falls towards support. Now, most of you will understand how support works, and sell the price when it rises towards resistance. Trade the break. Now, there are other set of investors and traders who look to trade on the break. Every time the price breaks up through the resistance. So in this case, this particular area was the resistance, and every time it breaks above this, you can take a buy and sell when the price breaks through the support. So every time it breaks through the support, you can take a sell. So what was your resistance at one point in time could become your next support. I will show you an example on this as well. So once upon a time it was a resistance, at then eventually it can become your support as well as the market keeps climbing further and as years or days pass by. Now, plotting support and resistance level over here, we have S&P 500 chart. We see a lot of candlestick patterns, candles which has formed. Now, here we are looking at a 5 minute duration. Uh, Keep in mind every candle represents every 5 minute move. Okay, if I'm looking at a daily candle, every candle represents every daily move. Now every 5 minutes we have a price it opened at, and the price it closed at. On a red candle it opened on the higher level and it dropped as low as this, and the next 5 minutes again it continued dropping after it opened lower, and hence this the red candle. Over here you see it opened lower, closed also lower, but before it closed it went as high as this price, but it came back down and closed below its open, and hence it has a smaller body. So now the body represents the open and close, the tail represents how high or how low it went in that particular duration or time. In this, we are looking at a 5 minute duration. Now, one thing you will notice is the price has been going to 4,140 and it gives a steep drop. It goes back up 4,140 gives a steep drop. Again, it recovers all the way till 4,140, gives a steep drop. Now, it's very evident that every time it goes to 4,140, people are selling off SPX. Similarly, on the lower end, every time it comes around 4,120, people are buying. Unfortunately there's no line over here, but this also is a support because the price action over here you will see multiple times from this region prices jumping back up. So what do traders do every time it drops down to 4120 or 130? They take a buy and it bounces back up, and once it goes to 140 they book the profit. So it's as simple as that when it comes to support and resistance. Now, a support and resistance does not necessarily have to be horizontal like the one we just saw. They can be in a trending market as well. The market eventually keeps moving up during a bull market cycle, and market keeps trending down during a bear market cycle. So we will not find the perfect support and resistance if you're going to be waiting for a sideways market. Yes, there are markets that trade sideways. Those are known as consolidation phase, and that could happen for a smaller duration or could happen on a longer duration and could happen on any instrument. But that would be a very easy trade to do, but it does not often appear. Although it can appear in shorter time frames most of the time when it is consolidating. I will explain to you how consolidation looks as well. Now, on a downtrend, you see market comes, makes a low, and goes back high, but it does not break the previous high. So this is known as it comes low and makes a lower high, and then second time it comes makes a lower low and makes a lower high, makes a lower low and makes a lower high, makes a lower low and makes a lower high, and basically every time it comes down it's coming down more. When it goes back up it goes up less. So now in this case if you draw your same support and resistance line but on a trending manner you will find your resistance. Similarly, you can draw the same thing on the lower end. So you know where your supports are. So every time it comes down to the support line, you buy. Every time it goes to your resistance line, you sell. One key thing that you can keep in mind is anything that is a support or resistance will be a valid support or resistance only once it occurs multiple times. Minimum 3 times is required to confirm support and resistance or even a trend. If it has happened just one time and then it is bouncing back up, I would not suggest you to take the trade on the second upside, because till your second point has formed, you still do not know if it's a trending down market or not, and only on the third time it confirms that it is a trending market. So fourth time onwards is when you should be ideally looking to trade. But if you don't want to miss the opportunity, you can always take advantage on the third time, provided that you have all the risk management in place. We'll just take a 5 minute break and we will continue from here. If you'll have any questions so far, please feel free to write it on the chat. I will be explaining and I will give you an answer before the session or during the session while we're doing this. Hi. So let's continue with the session. I'm not seeing many questions. So I'm guessing you're getting the hang of technical analysis. All right, now coming to trend lines. Coming to the sideway market, the consolidation market. Like I mentioned to you, a consolidation market is where you see the market moving in a sideways direction. Now, this is a very beautiful spot to be in, especially for short-term traders who would love to buy at the lower price, sell at the higher price, buy at the lower price, sell at the higher price, and I wish the same price continues throughout the year, so it makes easy to make returns. But then, unfortunately, consolidation usually occurs for a very short period of time before it continues on an upward trend or a downward trend. And same rule applies. We need to wait for at least 2 to 3 times of these patterns repeating before we confirm a support or resistance. So in this case, this was the first time, this was the second time, and probably on the third time you could have taken a short position. Similarly, first time, second time, on the third time you could have taken a long position, and it continues. So we'll look at a couple of live examples as well. Now, since we understand support resistance sideways, at the same time we understand trending support and resistance. Now, using these support and resistance, people have identified patterns that appear in the market, which a lot of technical traders look at these patterns to trade on either breakout, like we discussed a little earlier, or you buy it on dips or buy it on rise. Uh, Now, breakout is something that you buy when the prices are at the higher price, whereas when it comes back to the support on the lower levels, is where you look at buying when the market is on a discounted price. Now, looking at these patterns, do not get overwhelmed. I'll show you a couple of examples as well, but just keep your eyes focused on the blue lines in all of these patterns. So these blue lines are the ones which is creating the support and resistance. Now, if you find, like, I'll give you an example on a few of these patterns as well. Now, in this case, we see the price action. The red line is the line chart. We haven't used a candlestick chart over here because there'll be a lot of candlesticks which will give us not a clear view, but a line chart always gives you a much more clearer view. So in this case, you see the price action going up and it comes down. So it made a higher low and then it made a lower high and it made a higher low and it made a lower high. Now this basically starts squeezing in. Basically, it's not making a new high, nor is it going down further. So basically, it is consolidating, but in a very skewed manner. So every time after it comes on an uptrend, every time it comes from a lower point and goes sideways and gets skewed the pricing, we can always expect the prices to break above and continue on the upside. Now, in this case, how do we understand how much profit we should be looking at or how much stop loss we should be looking at? I will show you in a couple of examples, but just get the understanding of what a symmetrical triangle means. So, symmetrical triangle basically up and down, you will see it is symmetrical. It's not, the downward slope where you see over here is an descending triangle where the upward move has been lower, but the lower move has been flat. The support has been on a very straight line. So those are the few nitty gritties that differentiates from pattern to pattern. But apart from that, the whole idea of using these patterns still remains the same. Whether it is a symmetrical triangle or it is a descending triangle, or if it is a wedge, or if it is a rising wedge, dropping wedge, everything in terms of support and resistance, the foundation remains the same. Few different patterns that you would find unique would be cup and handle, which basically, if you look at a chart, if a pricing, you'll see a huge swing that goes this way, and that makes your cup, and a small swing before it gives a breakout. And in this case, you enter after it gives a breakout, and your take profit or your profit will be the length of this depth in the cup. Now, I will give you a couple of examples on that as well. Cup and handle actually appears a lot on a lot of charts. So it is a good indicator to look at, and good technical tool that can help you gain good momentum trades in the market. Now, head and shoulder again, very easy to understand. You will see there's a shoulder that has formed, and this bigger triangle price movement makes the head. Again, the price came, it took resistance here, and it dropped. Now, this, if the head and shoulder pattern appears, it is said once the neckline. Now, the neckline is basically which connects both the shoulder and the head on both the sides. When that breaks, you can take a short position, meaning you can sell the market and gain from the market dropping. You have a reverse head and shoulder. Similarly, once it breaks above this, you can expect the prices to break above it and continue moving higher. How high can this particular pattern give us returns? The returns will be as in depth as this particular drop here. Now, between the neck and the head point, let's say this was a 10% drop, and then market came back up and it gave a break above, you can expect a 10% more on the upside. And that is how you measure your targets. Now, let's look at a couple of examples. I'm sorry about that. All right, now let's look at this particular example. Now I'm looking at silver. Okay, on a 15-minute time frame, that means every candle represents a 15-minute time frame. Now, in this case, you see market had trended up, it changed the trend, it started dropping down, and as it was dropping down, it creates a wedge or a triangle. And once the triangle gave a break below, so basically you can see the price movement is getting skewed, meaning there was a downtrend and there was a consolidation phase. And once the consolidation phase ended, it broke below, and you see the prices dropping low. Now, how do people take a trade like this? They will take a trade only once the triangle breaks, or if it is a sideways channel, or if it is a different kind of wedge. They first identify the wedge pattern. In this case, this has been creating higher lows, so the line goes upward curve, whereas the resistance on top is solid. It's on a straight line path. Like I mentioned to you, everything is a trend or a resistance only when you see 3 points connect. So here I have one, two, and there's a third point connecting at the same price. Similarly, first point, second point, third point connecting at the same line, and hence this pattern has been made. Now, once the break happened, which happened over here somewhere here, you take an entry that was at the price of 23.85. You take a short position, and you keep a stop loss basically above the wedge. You can keep a stop loss closer, but in this case I've kept it a little further because there are times where it could kind of go back up, trigger your stop loss, and then drop. So it's always better to give some room. But I will explain to you how much room, because too much room also is dangerous. And second is it dropped down below. If you notice, this is the green line, which is the take profit. I could have taken a profit right at the bottom, but I haven't, because the reason for that is we do not know once it starts dropping how low can it go. But one thing that we can always measure is how long was my starting downtrend, right? Let's say if this was a 3% drop, I can expect similarly a 3% drop here. So I will always choose to keep take profit of 2.5 to 3%, so that I can capture that moment. Now, keeping it too close might is also sometimes not good in some cases. Keeping it too far, you might probably end up missing the profit, because the market might just jump right back up. So it is very, very crucial to identify where you need to enter first and where you need to exit, both on the profit and loss side. Now, in the case where you keep a smaller take profit for the probability of higher capturing of the profit, you may do so, but then your risk reward becomes bad. Like in this case, I have put a stop loss here. That means if it goes against me, I'm going to be losing about 150, in this case, let's say $200 here, $163. I lose $163 is what I'm willing to lose on this particular trade. And when it goes down, if I book my profit for $100, it does not make sense, because if it had to go against me, I'm risking more than how much I'm willing to make. The max you could do is 1 is to 1. You're risking $160. Maybe when it makes 160, you can take a decision to book your profit. But again, that is always going to be 1 is to 1. It's always better to have a 1 is to 2 risk reward. If you waited till the target level, it would have made about $400, so which is the double of how much I risked. So in case my next trade goes against me, it is completely fine because I'm not going to be losing my entire profit. I might lose half of the profit that was made on the first trade. So your risk reward is very, very key, and for you to understand how to keep stop losses and take profit is also very, very, very important. Excuse me. Let's look at the next example. Now, this was a bull flag. I think I did not explain a bull flag over here. So you can see a flag. So bull flag or a bear flag usually appears pretty much happens exactly like a triangle, but this has more momentum to it. You'll see a sudden spike in the market, a sudden trend picking up, and then it consolidating on a lower channel, or it could also be a lower triangle. It still remains a bull flag. And once the channel or the triangle gets squeezed out and breaks above, is where you take a buy action and expect the price to continue moving high. How high? As high as this entire rally that took place. Now, here's an example. I think this happened recently, if I'm not wrong. Yes, this has happened recently. So we see basically there was a sudden spike here. You will see this was also pretty much a bull flag, but it didn't give too much time to form a flag and it continued the rally. But then the second rally, you see it began. There was a sudden gush of trend here, and there was a consolidation period where it dropped, and after the break above, it continued the uptrend. Now same in terms of entry and exit. You always enter only once it breaks out of the channel or out of the triangle, and you keep a stop loss below the triangle or below the channel. And your take profit is very simple. Take profit would be the same length of this entire upswing, and take stop loss below this. Now, in this case, let's see, I risked again about $134 to take this trade to make a profit of $340. Now, again, more than 1 is to 2, 1 is to 2 risk reward ratio. So, again, this would help me benefit more. Now, let's say I get two trades in my favor, which makes $400 each, so that's $800 profit. But now let's say four trades need to go against me when I keep a stop loss of $200 for me to actually lose out my gain that has been made on short term trading. So your risk reward is the key to becoming a successful trader or an investor. Now, of course, when you're investing, you're looking at a longer time frame, and you might be looking at a lot more in terms of fundamentals. So the risk management over there slightly differs. It is more about getting good entry points and averaging it at good levels. But when you're doing short-term technical based trades, your risk reward is key. Let's look at one head and shoulder on S&P 500. Now, S&P 500, this is a monthly chart. In this case, I have not used the candlesticks because there'll be a lot of candles, so you won't be able to make out what is happening. But you notice over here, you can see a bull flag here as well. So there was a rally, consolidation, rally again, slight consolidation, rally again. So you can see pretty much almost one. So this was one bull flag, this was two, this was three. So like this, bull flags happen on a upward market and bear flag happens on a downward market. Now let's focus on the head and shoulder that we had discussed. We saw that there's a shoulder that forms, market comes down to a price, goes back up, makes a head, comes back to the shoulder again, to the neckline. I'm sorry, this is the neckline, and then goes back to the shoulder and comes back to the neckline. Now, the neckline is very clearly defined here. So is the shoulder of both the sides, and the head, which is longer than both the shoulders. So this basically, by the time it form one, two, three, four, five, fifth point, and it starts dropping here, you know it is a hidden shoulder. So what do? You prepare for a breakout. In this case, the breakout is once it breaks below the neckline, you take a sell position with a stop loss above your shoulder. Okay, I can keep a stop loss right above my sell, but then not wise, because there could be a slight momentum back upside before it starts dropping, and I don't want to get stopped out. So you give enough space or enough room for a stop loss. Again, not too far away where stop loss does not make sense. So in this case, I'm risking. So if you notice my other two trades, I made 160 and $400 profit. But in this particular scenario, I'm sorry, let me just go back. In this particular scenario, I'm taking a risk of $5,000 to make $9,000. Please don't get me wrong. This is basically a long term view. Okay, there's someone who's looking at a monthly chart. So anyone who is looking at a monthly chart or a weekly chart, like I told you, they're looking for a very longer time frame, minimum 6 months to 1 year, and it could easily go up to 2 to 5 years as well. So if you're looking to make a return for, let's say, after a year or 2 years or 3 years, you would always want a higher return, because you're not looking at a short-term trade now. But when you're doing short-term trades, you will have multiple opportunities, whereas in a monthly chart you get one opportunity probably once in a year or sometimes once in 2 years. So hence the risk reward accordingly. Still, if you, according to your risk appetite, you can always modify it by just changing your amount of investment. Instead of $85,000, if you just invest $8,500, your risk is going to be $530, and your reward is going to be almost $970. So, but the levels do not change; everything remains as it is. So I hope so far everything's clear for everyone. Now, coming to average true range, one last tool that I would like to teach before I show a couple of live examples. So, average true range is nothing but, in simple words, to tell you, it is the average movement of a particular instrument or a particular product. For example, if you're looking at gold, you would like to know how many dollars can gold move in a single day. So, average true range gives you that on an average. So what it does is it calculates for the last 10 days, 15 days, 20 days, 50 days, on an average how many dollars did gold move up and down. One point to keep in mind over here is it does not tell you the direction of the move. It only tells you how many dollars it can move between the high, low, and open, close, and low and high. Now, if for example, let's say a stock moves $5 every day, a investor or a client or a trader would like to take advantage of that $5 move for the day, uh, by either buying or by selling, depending on the technical analysis. He understands that that particular stocks moves $5 on an average every day, and if he can take advantage of it, he can take advantage of a $5 move. That, as simple as that, that is what average true range gives us. Now I'll tell you how you can use average true range to actually keep your stop loss and take profit as well. Now, just not on daily chart. If you want to understand how many dollars can gold move every 5 minutes, you can see that as well if you're trying to take advantage of a short term move. Now, if you want to know on a long term view, you want to know how many dollars can gold move every month, you can also measure that using ATR. People who invest, they look at weekly and monthly for longer term. Now, if you go to the chart, you have technicals. You go to studies, you will find ATR. If you are not using a platform from us, you can always take a demo to understand how it works. These tools basically are available even on all the other public platforms, so you can use those platforms to learn ATR as well if you do not have an account with us. Now, let's say for SPX, I'm looking at a monthly time frame. Okay, SPX is the top 500 companies index. ATR, I clicked on ATR and ATR opens up for a monthly time frame. It is telling me every month SPX expected move on an average as of today is $341. So you can expect SPX to move $340 up or down at this point in time. So that is what SPX is telling us. But if you want to see what happened back in history, let's say in 2008, in 2013, in 2008, 2013, SPX was moving only $100 a month. So if you had to take a decision back then, you will take a decision based on expecting SPX to move only $100 every month. But if you're taking a decision as of today, you will keep in mind that SPX can move $340, almost three times more than what it was 10, 20 years back. So you will take your decision accordingly. And it here actually helps you a lot with your stop losses and take profit. And also in certain cases, when to buy something and when to sell something. I'll show you a couple of examples and that'll help you out with the ATR as well. If you like the webinar, please go on Google and please give us a review if you liked the education sessions that we've been doing for you. Let's get into the live chart. I'll just share my screen. Just give me a moment. All right. Here I have a live chart. Let me open the SPX itself. Okay, so this is interesting. There are a lot of movement happening. Now let's look at a 30-minute or a 5-minute, 10-minute chart. If there is any particular instrument that you want me to cover, please feel free to write in the chat. I can show you these examples on those instrument as well. If you want me to do this on Tesla, if you want me to do this on gold, if you want me to do this on crude oil, pretty much anything that you would wish for me to, do this uh, examples for you. I can do that on those instruments. I'm just taking SPX right now as an example. So let's look at SPX I'm looking at a 10-minute chart. So now in this case, I can see SPX is, okay. So there's a pattern here. I can see that SPX, if you notice, one, so there are a couple of supports it has taken. Okay, there's one support here, there's one support here, there's one support here. So basically, this is my third confirmation that this particular price over here is a strong support. So now the next time it comes to 4020, I'm going to take a buy. I can keep a limit order at these levels, right? And I can keep a stop loss and I can keep a take profit at this resistance. Now in this case, let's say I do a $10,000 worth of trade. Oops, sorry, 1 million worth of trade. Yeah. So in this case, I am looking at a $10,000 investment because I have 10K in my account. I'm going to be risking about $15, $20. Let's make this $20. Always better to give it some room. And if it goes back to its previous highs or even somewhere here, I shall make about $64. So that's pretty cool, right? So on a short-term trade, I'm getting a very good risk reward. I'm risking about $20 to make 64. Now, in the case where I am a little more aggressive, I don't mind risking more. I can always take bigger quantity. Let's say instead of 2.5 units, I will do a 10-unit trade. Now, same trade, same levels. I'm risking $80 to make about $300. Now, if I want to risk a little more, I can always do 15 units and I can risk about $100 to make almost $400. So the risk reward is good over here. You're getting almost 1:3, 1:4. In fact, so that is how you do your basic analysis. Now, can you just depend on this trend line to take the trade? No. This is one of the factors that you'll be looking at to take the trade. Second, now in terms of keeping stop losses and take profit, I'm going to go to my ATR. Okay, I clicked on my ATR. Now, what is my ATR telling me? My ATR is telling me that it on a 10-minute time frame. I'm looking at 10 minutes, a very short time frame. In every 10 minutes, I can expect uh, SPX to move about $8.5. So let's say on an average, it moves about $8. Now, in the case, let's say if I do 1 unit, I am going to keep a stop loss of $8. Okay, because it's already dropped more than $8. So keeping a stop loss of $8 makes more sense. And I'm going to keep a take profit of double my stop loss or three times my stop loss. So double of 8 is 19. You can go three times as well, 27. And now, what you would have noticed over here is I did not open my ATR earlier. Okay, without using my ATR, I just used very basic support resistance to identify entry point one and stop loss and take profit purely based on the price action two. Now, I reconfirm this with my SPA, sorry, with my ATR. So now I know my take profit and stop loss is logical and it is put at a correct level. I'm not putting my stop loss like, let's say if the same thing with $8 stop loss. If I was gonna do a 50-unit trade or let's say 20-unit trade, I'm risking about 174. Oops, this came down. Sorry, I'm risking about 174 to make about 500 $600 profit. But let's say if I did not use any logic and I keep my stop loss lower, then you can see my risk reward is quite bad here. The trade is coming, so let me just take the trade. uh, Market, okay, done. Perfect. So I've taken this trade with the stop loss. So hopefully, since it's a 10-minute trade, we can see either stop loss or take profit triggering. If the session ends before that, you can always continue watching SPX price action. After we end the session, you can see whether if it came to 4010 first or if it went to 4050. So if it went to 4050 first, I made a profit. In this case, I'm making a profit of $500 for a risk of $200, which is not bad. Now, if I did not keep the stop loss, or if I keep the stop loss very far away, if I keep it far away, bad risk reward ratio. If I do not keep a stop loss at all, is where your entire portfolio will be under danger, because one is you have taken a very big position on one single trade. So for you to be a successful trader, you use the tools that we have learned today. You use the ATR to help you identify. Oops, I'm sorry, to help you identify your stop losses, take profit, and also identify your entry point using trend lines, using support resistance, using other technical tools. You can, if I go on SPX today, if I go to my line chart, I would probably find couple of head and shoulder, or let's say I found a reverse head and shoulder on a weekly chart. Okay, let me hide this trade. So now you can see there's a reverse head and shoulder on a weekly chart as well. So if I'm doing anything for the long term, I will be taking a trade based on this. So market dropped, shoulder formed, neck, shoulder, neck, shoulder. Let me just make this right. So next shoulder, next shoulder. So basically, It is trying to break above. It hasn't. This is a monthly chart. It is trying to break above these levels, right? It hasn't broken yet. So I do not take any action. I take an action only once it breaks above the neck, and I expect it to go back here. So, oops, sorry. Yeah. So this is the expectation, but this trade would be taken only once a break happens. And in this case, this is my neckline over here. Once the neckline breaks, I take a buy. I will show you how this particular, because this is a longer term trade again, so probably a little more uh, risk appetite on this. Stop loss very clear below the shoulder. Okay, there are two shoulders, so if you want to keep below the other shoulder, that's still good enough. Entry point after the breakout, and exit point pretty much as high as the entire move. Now, in this case, if I do 1 unit, I'm risking about $300 to make about $580. If I do about 25 units, I risk about $9,000 to make about $11,000. Now, in this, the risk reward is not that attractive because I've kept my stop loss like way below the previous shoulder. That is just to be more cautious, but eventually I'm expecting the markets to pull up whether we have a recession. Then after a recession, market could still pull up. But if I want to be more cautious and I'm taking a very high leverage trade, I would always keep a stop loss. Even if I keep a stop loss close by, I can always change my number of units to, let's say, 5. And in this case, if I'm going to risk about 2,400 to make a $2,200 profit, it's still not bad. I mean, it's still not a very bad risk reward ratio. And eventually, if market can pull back up further, you can make a bigger take profit. But like I mentioned to you, you always go by the rules. You stick to your stop loss and take profit based on the pattern. And in this case, it's not a very great risk reward trade, but nevertheless, it is a good pattern that could work out in the long run. Let's look at our short term trading. This trade is still open, 10 minutes. Do you all have any questions in the meanwhile before we wrap up for the day? All right. Thank you all for joining the session. Keep an eye on SPX if you're watching. 4010 was the stop loss, and 4050 or 4049 is the take profit. Let's hope this one hits the take profit. Right now, it looks like it's breaking below the support, but that's okay. Risk management is the key because here you would want to have a peaceful time with your family. You do not want to keep looking at your account every 5-10 minutes. Always keep your stop losses, take profits. You can close the trade. You can close your mobile and go about doing your daily work. I hope this session was informative, and I hope you all liked this session. If you all have any feedback for me, please feel free to write to me. You can leave comments, and if you want me to cover any other topics, please put in the comment as well. Thank you again for joining today in the evening, and hope to see you all again soon. Take care.